Here we're going to take a look at Chapter 5, Part 2 homework, where we have to do these exercises. We'll do exercises 1 through 5 on here. Okay, for supplies, the supplies account has a balance prior to the adjusting entry. That means it has a balance on the trial balance, okay, of $320. The physical count of the supplies inventory shows that $90 of supplies remain. Okay, so we need to analyze this using T accounts and then put the adjustment in a general journal format. And so we have $320 in the supplies asset account, but when we count up the supplies on the shelf, there's only $90. So we're going to go to our T accounts, and here we have a supplies account, and there's $320 balance in there. And of course we know that supplies is an asset, and therefore this balance is a debit balance. Now we need to get, so the balance down here, the bottom is $320 debit balance. We need to get to the balance equaling the reality of $90 that we counted on the shelf. So we must have used some of the supplies during the month. So we're going to take $320 and we're going to subtract the 90 that's still left. And that shows us that we have $230 that we used of supplies. So whenever we use something, okay, we no longer own it, so that $230 has to come out of the asset account. We no longer own it. Okay. And let me, okay. So now what is our new balance of the supplies? We have $320 debit footing, $230 credit footing, big number minus the small number, and put it on the side of the big number, which is 90. Okay, so now our asset account equals what we actually, in reality, have on the shelf. That's what we want. This needs to be 90. If you do your journal entry and you accidentally put 90 as your credit, then you're going to end up as 230 on your balance, and 230 does not equal the 90 that's on the shelf, so you would have an error there. Now, we said that we're going to credit this 230. Of course, we're going to need a debit, so we're going to do supplies expense. Okay, this is an expense account, and our 230 will go there. And so our balance of the supplies we used, okay, we used 230, so we took it out of the asset because we no longer own it, and we put it into supplies expense, and every expense is when we use stuff. Okay, so that's what we want to do. We've now analyzed it. Now we need to put it into a journal entry. So we know that we want to debit supplies expense, credit supplies. So here we have our date. The journal entry is always, let's see if they gave us yet, December 31st. Okay, always the last day of the period is the date that we use for adjusting entries. And we said we were going to debit. Debits always come first, so we said we were going to debit at supplies expense, so that'll come first, and that was 230. We put our dash there to show our pennies, and we're going to credit, so we indent the asset called supplies. Okay, our debits equal our credit, so now we have our explanation. Used supplies for December. Okay, so let's take a look at the next one. This one is for insurance. On December 1st, 6-month liability insurance policy was purchased for $900. We need to analyze using T accounts and then put the adjustment in the general journal. Okay, and so 900 on December 1st, and that was a 6-month policy. So when we purchased this on December 1st, we had put it in prepaid insurance, and that was 900 that we had put in prepaid insurance. Okay, now it's at the end of the month and we have used some of that insurance. How much did we use? Okay, so we're going to take the amount that we paid for the policy, and we're going to divide it by how many months it covered. And so 900 divided by 6 equals 150, and so per month. Okay. Oops. All right. Okay, so this shows that roughly, remember, our adjusting entries are not by the penny. Sometimes Saying Gauge has you do it by the penny because of their automatic grading system. But in real life, adjusting entries are just rounded to the nearest dollar. Sometimes if you're GM, it might be rounded to the nearest $100. Okay, so we take the 900 divided by 6 months, and that gives us $150 per month, roughly, that we're using this. So at the end of December, I have used the prepaid insurance $150 worth. Now, okay, so because I've used that part, I no longer own that part. So when I take the 900 debit footing minus the credit footing of 150, I have 750 left. And so that says that I still own $750 worth of the insurance policy. That means I could take that policy back at the end of December and get roughly $750 back, because that's the part I haven't used yet that I still own. Okay, but I used the $150. Okay, so whenever I use something, to put it into a expense account, so we're going to call this insurance expense, and the 150 will go in there. And that gives us a $150 balance for insurance expense. So now we're ready to do our journal entry. We have to debit insurance expense, 150, and credit prepaid insurance, 150. Again, this will be December 31st. We said our debit was insurance expense. Always put your debits first, and that's $150. And prepaid insurance is our asset. That's being credited. My debits equal my credit, so I put my explanation. Used insurance for December. Okay, now we have the next one, adjustment for wages. Trial balance shows wages expense of $600 that we've already spent during December for wages, so it had already been debited to wages expense of $600. Now we have an additional $200 where we use the employees at the end of December, but their payday is not until early in January. So they haven't been paid this. So we hadn't recorded it yet because since we hadn't paid it yet. And so now on December 31st, we have to say, well, if we used the employees any amount that belongs in December where the employees actually worked in December, then we have to show that as a December wages. So with this one, you don't have to actually calculate anything. Our wages expense account, we already had the $600, and you need to know the other account that you're going to need, which is wages payable. That's a liability. We owe it out. Now here we have an additional additional 200 of wages that we used the employees for that we need to add to the December wages expense. Okay, and we're not going to pay cash right now on December 31st. They're going to get their cash when we pay the wages on whatever, January 2nd or whatever. So the 200 is going to go as a credit into wages payable. We owe out the employees. If our company went under tonight on December 31st, then we would still owe those workers already worked. We still owe that $200. Okay? And so now we have 800 wages expense for December, and we owe 200 to the employees at the end of the month. Now, what's in red is what we're doing for our journal entry. We're going to debit wages expense, credit wages payable. Debits come first. And credits come second and are indented. We use the employees at end of December